Hello and welcome to our Q3 2019 market review. I'm Darrell, Head of Investments here at Valley National Financial Advisors. It was a bit of a seesaw quarter for equity investors as heightened uncertainty regarding the U.S.-China trade negotiations, slowing global growth, and increased violence in the Middle East all stoked volatility in markets. And as if all of these issues weren't enough, at the end of September, House Democrats announced that they were moving forward with impeachment proceedings against President Donald Trump. Yet despite all the negative headlines and all of the uncertainty, markets still managed to push modestly higher throughout the quarter and ended the quarter up over 20% year to date. A lot of that has to do with a reversal in policy with the Fed, which has also been good for bonds. Bond markets also rallied during the quarter as interest rates moved lower. Longer-term interest rates tend to be closely aligned to the market's collective expectations for future growth and inflation. On the growth front, we are continuing to see evidence of slowing economic growth, particularly in Europe, where economies such as Germany and Italy may soon find themselves in recession. On the inflation front, we have seen an uptick in inflation expectations recently, primarily driven by U.S. tariffs and a tight U.S. labor market, but those expectations could be reversed if we do get a trade resolution, which is our base case scenario. Furthermore, trillions of dollars worth of foreign bonds now trade at negative yields, a phenomenon that has driven demand for U.S. bonds higher and helped contribute to the decrease in yields here at home that we've seen throughout the year. Amazingly, it wasn't too long ago that many bond experts were saying that the Federal Reserve's policy would lead to higher rates here at home because of a supply-demand imbalance. The rapid transition from many investors fearing rising rates to those same investors struggling to find yield is a testament to the unpredictability of markets and, in our opinion, a strong argument for maintaining a balanced approach to portfolio management. The third quarter was filled with uncertainty, much of which will not be resolved for quite some time. But one thing that was made abundantly clear throughout the quarter with the Fed's decision to decrease its target interest rate on two separate occasions was that the Federal Reserve will do as much as it can to maintain the strength of the global economy, or the U.S. economy in particular. That said, we believe investors would be better served by focusing on economic fundamentals rather than the Fed. Eventually, the Federal Reserve's influence on the stock market and the economy will begin to wane, and all that will be left to drive markets over the long term will be things like economic growth and earnings growth. And while it is true that some of the economic fundamentals are starting to flash warning signs for investors, the big wild card, as it has been for the past 2 years, is the U.S.-China trade negotiations. If we're able to reach a negotiation agreement with China, that could leave room for manufacturing to begin to recover and for economic growth to begin picking up again. In any case, with the strong returns achieved by both stocks and bonds throughout the first 3 quarters of the year, investors will likely benefit from beginning to rebalance portfolios back to long-term targets moving forward. Thank you for joining us for a Q3 market review. We'll be back next quarter with another update.